In 2026, the oldest baby boomers are turning 79. The youngest are 61. This is no longer a theory about retirement. It is happening in real time. According to the Federal Reserve's survey of consumer finances, 43% of Americans aged 55 to 64 have no retirement account at all. Among those who do have one, the median balance is roughly $185,000. On paper, that might sound substantial. In practice, it is not designed to fund a retirement that could last 25 or even 30 years. At the same time, labor force data from the Bureau of Labor Statistics shows that nearly 1 in 5 Americans over 65 is still working. Some choose to. Many do not. For decades, baby boomers were described as the luckiest generation in modern American history, beneficiaries of post-war growth, expanding home ownership, and rising markets. Yet as this generation moves fully into retirement age, the financial outcomes look far less secure than the narrative suggests. So what actually happened? Was it overspending, poor planning, or something more structural, something built into the economic system itself? If we want to understand why so many boomers are entering retirement financially exposed, we have to start with one structural shift: the collapse of the pension system and the rise of individual investment accounts. For much of the post-World War II era retirement in America was built on what economists call a defined benefit model. Large employers promised workers a predictable monthly payment for life. The formula was clear: work for 30 years, retire at 65, receive a check every month until you die. Social Security supplemented that income, but it was rarely the only pillar. By the late 1970s, that model began to erode. The Employee Retirement Income Security Act of 1974, known as ERISA, was designed to protect workers after several high-profile pension failures. It increased reporting standards and funding requirements. While protective in intent, it also made pensions significantly more expensive for employers to maintain. Then, almost quietly, Section 401 subsection K of the tax code was passed in 1978. It allowed employees to defer taxes on income placed into retirement accounts. By the early 1980s, companies realized something important. This structure shifted long-term retirement risk away from corporations and onto workers. Under a pension, the employer bore the investment risk. Under a 401k, the employee did. Baby boomers were the first generation to experience this shift at scale. Many began their careers expecting pensions similar to their parents. Instead, they were handed a system that required them to self-direct investments, choose asset allocations, and manage market volatility over decades. Compounding the challenge, financial infrastructure was primitive compared to today. No automatic enrollment, no default target date funds, no low-cost index funds widely adopted. Participation rates in early 401k plans were modest, and many workers either undercontributed or cashed out balances when changing jobs. This was not a minor administrative change. It was a structural reallocation of responsibility. For the first time in modern American history, retirement security depended not just on years worked, but on investment literacy, behavioral discipline, and market timing. And for a generation whose first major experience with the stock market was not a bull market, but a long period of stagnation and inflation, that shift carried consequences that would take decades to fully unfold. One of the most common financial arguments today is straightforward: start early, invest consistently, and allow compounding to do the heavy lifting. The math behind that advice is solid. However, it assumes something important. It assumes that early market conditions cooperate. For many baby boomers entering adulthood in the late 1960s and early 1970s, they did not. Between 1966 and 1982 U.S., equity markets experienced an extended period of weak real returns. Nominal prices moved up and down, but inflation ran high throughout much of the decade. Inflation peaked above 13% in 1980. When returns are adjusted for inflation, long-term investors during that 16-year window saw very limited growth in purchasing power. In August 1979, Businessweek published a cover story titled, "The Death of Equities." The headline captured a broader mood. Stocks were no longer viewed as dependable wealth builders. Bonds were offering double-digit yields. Cash felt stable. confidence in equity investing was low across the country. Generational investing behavior is often shaped by first impressions. Boomers in their early 20s during that period were not stepping into a strong expansion. They were stepping into stagflation oil shocks, wage pressure, and repeated market disappointments. For those who invested early, the experience was discouraging. For those who delayed, the hesitation was understandable given the evidence in front of them. Then conditions shifted. Beginning in 1982, the United States entered one of the longest bull markets in modern history. From 1982 to 2000, the Dow Jones Industrial Average rose from roughly 800 to more than 11,000. Inflation declined. Interest rates gradually fell. Equity ownership expanded into mainstream culture. But timing matters. By the time this sustained expansion gained momentum, many boomers were already in their 30s and 40s. Compounding rewards time more than intensity. A 20-year-old investor has decades to absorb volatility and benefit from exponential growth. A 45-year-old balancing mortgage payments, children, and career transitions does not operate under the same flexibility. The life cycle of this generation did not align cleanly with the market cycle. In theory, boomers benefited from the strong returns of the 1980s and 1990s. In practice, many entered more aggressively later in life after the earliest years of compounding had already passed. This is not an emotional argument. It is a structural one. The generation often described as having access to the greatest bull market did experience substantial gains. But the window for maximum accumulation was shorter than commonly assumed. Risk tolerance was constrained by midlife responsibilities. And when confidence in equities became widespread, valuations were already elevated. That sequence would prove significant, because the next stage was not expansion but contraction. By the late 1990s, confidence in the stock market had returned at full force. Equity investing was no longer viewed with suspicion. It was mainstream. Retirement projections assumed continued growth. Media coverage celebrated the rise of the 401k millionaire. Then the cycle turned. In 2000, the technology bubble burst. The Nasdaq Composite fell nearly 78% from peak to trough over the following 2 years. The broader market declined as well. For older baby boomers, many of whom were in their early to mid-50s, retirement accounts were heavily exposed to equities after nearly 2 decades of strong returns. This timing is important. Losses early in an investment career can be recovered through time and continued contributions. Losses later in life are different. Financial planners call this sequence of returns risk. When significant market declines occur near retirement, the portfolio has less time to rebound. Withdrawals compound the damage. The market did begin recovering in the mid-2000s. Home values were rising. Credit was easily available. Household wealth appeared stable again. Then came 2008. The financial crisis delivered a second major shock within less than a decade. Home prices fell approximately 27% nationally from peak to trough, according to Federal Housing Finance Agency data. The stock market lost roughly half its value from the 2007 high to the 2009 low. Unemployment peaked near 10% in 2009. For boomers approaching retirement age, this was not a routine correction. It was a structural hit to both sides of their balance sheet. Retirement accounts declined sharply. Home equity, often the largest asset for middle-class households, contracted at the same time. Older boomers were in their early 60s during the crisis. Younger boomers were in their late 40s and early 50s, which are typically peak earning years. Job loss during that window carries long-term consequences. Research from the Bureau of Labor Statistics has consistently shown that displaced older workers face longer periods of unemployment and lower re-employment wages. The recovery that followed was significant, but it did not erase the sequencing problem. Many households reduced equity exposure after the crash, locking in losses and missing part of the rebound. Others delayed retirement, which helped rebuild savings, but also reflected necessity rather than preference. The critical point is not that markets decline. That is normal. The issue is timing. Baby boomers did not experience a single downturn late in life. They experienced 2 major asset shocks within an 8-year span, both occurring as they moved toward retirement age. For households with substantial assets and diversified portfolios, recovery was possible. for households already behind the second shock made catching up materially more difficult. And by the time markets stabilized, another reality was becoming clear. The median retirement balance was not where many expected it to be. As of early 2026, the broad outline of the baby boomer retirement picture is clear. The details are uneven, but the median tells a sobering story. According to the Federal Reserve's most recent survey of consumer finances, 43% of Americans aged 55 to 64 do not have a retirement account at all. That means no 401k, no IRA, no tax-deferred investment vehicle tied specifically to retirement savings. Among those who do have accounts, the median balance is approximately $185,000. That number requires context. A retirement that lasts 25 to 30 years requires sustainable income. Using a conservative withdrawal framework, even a $200,000 portfolio does not generate high annual income without drawing down principal. At the same time, life expectancy for Americans who reach age 65 remains well into the 80s, meaning retirement is often a multi-decade financial commitment. Savings alone are not the full story. Debt in retirement has risen significantly over the past 3 decades. Federal Reserve data shows that a majority of retirees now carry some form of debt, including mortgages, auto loans, or credit card balances. In earlier generations, entering retirement debt-free was common. Today it is less so. Housing equity is frequently cited as a cushion. Many boomers benefited from long-term appreciation in home values. However, home equity is not automatically liquid income. Converting it into cash often requires downsizing, refinancing, or reverse mortgage products. Each comes with trade-offs. Social Security remains the largest guaranteed income source for most retirees. On average, it replaces roughly 40% of pre-retirement earnings for middle-income workers. For lower-income households, it replaces a higher share. For higher earners, it replaces less. The program itself faces long-term financing pressure. The Social Security Trustee's 2025 report projects that the Old Age and Survivors Insurance Trust Fund could be depleted in the early part of the next decade if no legislative changes occur. In that scenario, incoming payroll tax revenue would still fund the majority of benefits, but not 100%. This uncertainty influences behavior. Some workers claim benefits early at reduced monthly payments. Others delay to maximize payouts. The decision often reflects financial necessity rather than optimization. Meanwhile, labor force participation among Americans aged 65 and older remains elevated compared to historical norms. Bureau of Labor Statistics data shows millions of Americans beyond traditional retirement age still working either full-time or part-time. Surveys indicate a mix of motivations. Some cite engagement and purpose. Others cite financial pressure. The retirement experience in 2026 is therefore fragmented. A segment of boomers holds substantial assets and will retire comfortably. Another segment relies primarily on Social Security with limited supplemental savings. A third group continues working because the numbers simply do not close without earned income. When discussions focus only on average wealth, they obscure this distribution. The median balance, the prevalence of debt, and the dependence on Social Security together form a clearer explanation than any single data point. The system does not fail everyone, but for a significant portion of the generation, it has produced outcomes that are financially tight rather than secure. It is tempting to reduce retirement outcomes to personal responsibility. Spend less, invest earlier, contribute more. Those factors matter, but they do not operate in isolation. Over the past 4 decades, wage growth for many middle-income workers has not kept pace with productivity growth. While aggregate GDP expanded, income gains were unevenly distributed. Higher-earning households captured a disproportionate share of asset growth, particularly during the long equity expansion following 2009. That divergence matters because participation in equity markets is strongly correlated with income level. Healthcare costs represent another structural pressure. Out-of-pocket medical expenses tend to rise with age, even for individuals covered by Medicare. Supplemental insurance, prescription drug costs, and long-term care needs can materially affect retirement budgets. These expenses are difficult to predict precisely, which increases precautionary behavior and financial stress. Longevity also complicates planning. Life expectancy at age 65 now implies that many retirees will live 20 years or more. A longer lifespan is a positive outcome socially, but financially, it requires a larger asset base or more conservative withdrawal rates. Underestimating longevity risk can result in either overspending early or excessive caution that reduces quality of life. There is also substantial inequality within the baby boomer generation itself. Upper income boomers, particularly those with continuous labor force participation and exposure to equity markets, often accumulated significant wealth. Lower income boomers, or those with intermittent employment, limited access to employer-sponsored plans, or prolonged unemployment during recessions, face very different outcomes. In other words, boomers retiring broke is not a universal description. It is a median and lower half phenomenon. The top quartile of the generation holds a large share of total assets. The bottom portion holds very little. This dispersion reinforces a central point. The retirement system now amplifies differences in earnings market participation and financial literacy over a lifetime. It no longer compresses outcomes through guaranteed income structures. When risk is individualized, outcomes diverge. The story of baby boomers entering retirement is not a simple morality tale about discipline or excess. It is the result of three overlapping forces. First, the retirement system shifted from guaranteed income to market-dependent accounts. Risk moved from institutions to individuals. Not everyone was prepared for that transition. Second, market timing mattered. A weak inflation-adjusted environment early in adulthood followed by two major asset shocks near retirement age compressed the window for accumulation and recovery. Third, the numbers, in 2026, show that median savings, rising debt in retirement, and heavy reliance on Social Security create financial fragility for a substantial share of the generation. Some boomers will retire comfortably. Many will manage carefully. Others will continue working longer than expected. Understanding this trajectory matters not to assign blame, but to recognize how structural design and economic cycles shape financial outcomes across decades.